German economy shrinks by 0.3% in second quarter of 2025. Fed's Powell announces policy framework tweaks for changed economic landscape. And Syria will issue new banknotes, removing 2 zeros from its currency. The news in detail. The status has revealed that Germany's economy shrank by 0.3% in the second quarter, a decline that was 0.2 percentage points worse than initially reported in July. The Statistics Office noted that quarter-on-quarter gross domestic product had grown by 0.3% in the first quarter of 2025 and 0.2% in the fourth quarter of 2024. It added that industrial production in particular unperformed initial assumptions. In the second quarter, total export of goods and services were down 0.1% from the previous quarter. The status has also reported that Germany's general government deficit significantly narrowed to 28.9 billion euros in the first half of the 2025. This represents a 19.4 billion euros improvement from the same period last year, bringing the deficit ratio to 1.3%. The overall deficit reduction was attributed to the central government and German states, as the central government's deficit dropped by a substantial 10.5 billion euros to 16.7 billion euros, while the states cut their deficit by 10.3 billion euros to just 1.3 billion euros. The status also noted that Germany's improved fiscal position is due to government revenue growing faster than its spending. Total revenue increased by 6.5% to 1,042 billion euros, while expenditure rose at a slower rate of 4.3%, reaching 1,070.9 billion euros. For further analysis, we are joined from Paris by Director of the EU Asian Centre and former World Bank advisor, Mr. Meher Nicolas Ferzelli. Good evening to you, sir, and welcome to Qnews Economic Bulletin. Let me start by asking you, Germany's economy contracted by 0.3% in the second quarter of 2025, with industrial production underperforming expectations. Now, what factors do you believe are driving this slowdown, and how might this impact the broader Eurozone economy?
I'm delighted to join you today. I think we should not read too much from these figures. I mean, to make a very long and complicated story short, the figures are bad. So they're not dramatically bad, they're not horrible, it's not the end of the world for Germany, but they're bad. Because they show a contraction. So I think, year on, they show minus 0.3% contraction. I think the consensus, so before the data were published earlier today in Berlin, I think the consensus was flat. So most experts believed that compared to 1 year ago, it would be 0.0, completely flat. and it's minus 0.3%. So what I'm coming at, we have to give the data, most likely negative data, give them 2 or 3 more months to build a full judgment. But investors, especially investors in the stock exchange, they are very nervous, they're anxious for many reasons, beyond the slowdown of the German economy and President Trump's trade war, etc. So there are many reasons why investors are quite anxious the world over. So any hint of a bad news can be overinterpreted. So once again, what do the data tell us? That the German economy is shrinking across sectors. So it's not only industry or export oriented, because you would think that what Trump is doing or the new trade war is impacting essentially export oriented industry, which in the case of Germany would be heavy industrial equipment, machine tools, expensive cars. It's not only that, it's also the domestic consumption, domestic services, hotel industry, tourism, all that is quite bad. So to make a long story short, it is negative, but it could be worse in the coming quarters.
Right. Despite the GDP contraction, Germany has significantly reduced its government deficit in the first half of 2025 due to faster revenue growth compared to spending. Now, how sustainable or how significant is this fiscal improvement with regard to the current economic challenges?
Germany doesn't need that recent fiscal improvement. Why? Just like Switzerland, just like Holland or Luxembourg, Germany can bite the bullet. Why do I mean bite the bullet? Because their overall national government debt to GDP ratio is very low, like 40, 50%. Countries like Italy or France, their national government debt to GDP ratio is 130%, right? So it gives you a sense of the financial strength and stability of Germany. Their house is in order, just like the Swiss government house is in very good order. So when there is a shock, when there is a global shock, when there is a Trump trade war, etc., Ukraine war, when your house is solid in order, it can withstand is already so high, the governments in Paris and Rome, they have no room for maneuver. They have no fiscal, macroeconomic room for maneuver. The Germans, they have a good room for maneuver. So what I'm coming at is, that short-term improvement is good, but it's not something that will move the boat. The boat is very solid. So from that perspective, if there is a big crisis, which is very possible, if there's a big economic crisis in Europe in the coming quarters and semesters, the German government, if they want to intervene to, jumpstart the economic engine, how? By spending, if the German government decides to spend a lot of money on public infrastructure, transportation infrastructure, energy, and military infrastructure, which they will probably do more in the coming quarters, they can afford to do that, which is great for them. So if the economy really slows down, the government can pump up a lot of money by government spending into the system to make up for that slowdown in the private sector.
Right, but Mr. Fazeli, how would Germany's recent economic performance reflect or influence the European Central Bank's monetary policy decisions, particularly concerning interest rates and inflation control? And how would that reflect on Europe's economy at large?
So from the other side, right? So if you are anxious about interest rates, it's positive news because, when the economy slows down, and Germany is a big part of the Eurozone mainland European economy, a very big part. So if the German economy slows down and inflation is low, which is the case, inflation is very low in Germany today, then it gives an argument for the European Central Bank, which by the way is based in Frankfurt, also in Germany. It gives an argument for the ECB to lower a little bit further the rates. So if you're cynical, if you're a financial investor, very cynically and coldly, if you look only at your own interest as a financial investor, it's good news. In a way, in a certain way, within limits, it's good news because it increases a little bit the likelihood of the European Central Bank to decrease interest rates.
But we're speaking here about the monetary policies and the monetary, what could be the upcoming monetary choices or decisions. But how about the European economy at large?
Yeah, you know, one man's bad news is another man's good news. So if you are Italy or France, you are desperate for the European Central Bank to keep interest rate low or even lower them a little bit further. So the fact that the German economy is slowing down, but inflation is contained, next time the board of the ECB meets, right? Many board members are German or pro-German, let's say. It's, you know, the Bundesbank, right? The Bundesbank, German central banking philosophy, very cautious, very conservative. So these guys, you know, when they meet with their Italian and French colleagues next month, you know, the French and the Italians and the Spaniards, they will have more arguments to tell the Germans, you know, let's keep interest rates low, right? That's one thing. Another thing I want to say is there's a very interesting indicator which is often overlooked, is the performance of national stock exchanges, right? You know, people make that mistake, especially in America or Asia or the Middle East. They tend to believe that all European stocks, all European shares, they move in sync, right? They think that, you know, when French shares rise, German shares rise, etc. It's only partly true, only partly true. And in times of crisis or in times of anxiety and stress, it is not true at all. And this year has been a year of anxiety and stress. So this year, the performance of the German stock exchange is very different from the performance of the Spanish, Italian, and French.
So you're
right?
saying here that bad news for some would be good news for others?
Yes.
But not
And
for the bloc.
paradox, yes.
But not for the bloc.
Yes, absolutely. But another paradox, another bizarre thing, is that even though the German economy's performance this year is quite bad, mediocre, verging on bad, the performance of the German stock exchange is excellent this year, one of the best in the world, surprisingly. And that's,
Yes.
you know, the 30 index is up 22, 22%.
Yes, clear what you're saying here. However, my time is up and I have to end it here. Mr. Nicolas Frzelli from Paris, Director of the EU Asian Center and former World Bank Advisor. We thank you so much for your insights here. And back to our news. Market research firm GfK survey has shown that British consumers turned a bit more confident this month after the latest interest rate cut by the Bank of England, but are vulnerable to worries about rising inflation and potential tax increases. GfK's Consumer Confidence Index rose to its highest since December at -17, up from -19 in July, boosted by a 3-point improvement in household sentiments around their personal finances. GfK's measure of savings dropped by 4 points to +30 in August from its highest level since 2007 in July. And moving on to China, National Bureau of Statistics has reported that the retail sales of consumer goods in China rose 3.7% year-on-year in July to 3.88 trillion yuan. Data showed that sales of household appliances surged 28.7% year-on-year, while furniture and office stationeries rose 20.6% and 13.8% respectively. Meanwhile, online retail sales remained a bright spot, climbing 9.2% on an annual basis. In the first 7 months, sales of physical goods online increased 6.3%, making up nearly a quarter of total retail sales. Government data has shown that Japan's core inflation rate slowed for the second consecutive month in July, though it remained above the central bank's 2% target. This slowdown is fueling market speculation of another interest rate hike soon. The nationwide core consumer price index, the CPI, which excludes fresh food, increased by 3.1% in July compared to the previous year, while energy prices saw their first year-on-year drop since March of last year at 0.3%. Additionally, food inflation accelerated to 8.3% from 8.2% in June, indicating that rising living costs continue to strain household budgets. The South Korean government, in its new government economic growth strategy, has lowered its economic growth forecasts for this year to 0.9%. This marks a significant downward revision of 0.9 percentage points from its previous estimate of 1.8%, although the government anticipated that two supplementary budgets totaling approximately 30 trillion won will help boost consumption. The government expected their impact on the annual growth rate to be limited to just 0.1 percentage point. Additionally, the economy is expected to grow 1.8% in 2026. In Latin America, the National Statistics Agency has revealed that Mexico's economy grew 0.6% in the second quarter from the previous 3 months period. It added that growth in the quarter was fueled by secondary and tertiary activities, respectively, covering manufacturing and services, which rose 0.7% and 0.8% on a sequential basis. However, in annual terms, Mexico's economy was flat in the period. U.S. Federal Reserve's Chair Jerome Powell, in a speech at Jackson Hole, has announced an updated framework for the central bank's operations, acknowledging a return of higher inflation and a lower probability of near-zero interest rates. He noted that a shifting balance of risks may justify adjusting the Fed's policy stance. The latest data indicates that the 12 months personal consumption expenditures rose by 2.6% in July, with core inflation rising by 2.9%. Powell stated that the risks in inflation are tilted to the upside. Powell also highlighted growing downside risks to the labor market, adding that the stability of the unemployment rate allows the Fed to proceed carefully when considering policy changes. He also stated that a slowdown in job growth has not yet created a large margin of labor market slack, which the Fed wants to avoid. Now, moreover, during his speech, Jerome Powell stated that the Fed's dual goals of price stability and maximum employment are currently in tension, forcing the central bank to balance both sides of its mandate. He noted that the GDP growth has slowed notably, primarily reflecting a slowdown in consumer spending. Powell said that while it's possible that tariff-driven price pressure could create a lasting inflationary dynamic, it's unlikely, especially given the downside risks to the labor market. He also attributed an abrupt slowdown in labor force growth to tighter immigration policies. And for further analysis, we're joined from Washington by Mr. Peter Tanas, Chairman of Linux Investment Advisory. Welcome to Qnews Economic Bulletin, and let me start by asking you, what are the key reasons cited by Powell for the Fed's updated operating framework?
Nice to be with you again, Mona. It's important for everybody to remember, and you pointed this out earlier, that the two main mandates of the Fed are employment and inflation. So everything Chairman Powell talks about are centered on those two things. And the market reacted today, the stock market reacted quite wildly to the upside. The markets are up 2% today so far because the Chairman Powell hinted that there's probably going to be a rate cut at the meeting in September. And the odds now are over 90% that that will happen, but it's not certain.
Now, from your point of view, how does the current inflation data, specifically the July PCE and core inflation numbers, influence the Fed's policy outlook?
Yeah, so interestingly, in prior meetings, the concern of the Fed and a lot of other people has been that tariffs were going to have an effect on inflation and raise prices, which is something the Fed was very wary of, and that's the reason the Fed wasn't eager to lower interest rates earlier. But so far, the effect on inflation has been muted. It has not been that serious. So the Fed has shifted the emphasis now on the unemployment rate. The unemployment rate has been ticking up a little bit, and that concerns the Fed. A higher unemployment rate would be an indication for lowering interest rates to give a boost to the economy. The Fed didn't want to lower interest rates when the unemployment rate was very low and inflation was a concern. But those fears have eased.
Now, why do you think Powell believed that a shifting balance of risks may warrant adjusting policy stance?
Precisely. And that's why there's a 90% chance that the Fed is going to lower interest rates in September. Keep in mind, though, that we will have another inflation report and another employment report before the next Fed meeting on September 17th. So depending on those numbers, the situation could change. But the odds now are strongly in favor of a cut in September.
But here, what did Powell mean by the curious balance in the labor market? And how does he explain this phenomenon?
Yeah, as I pointed out, the labor markets, as far as the data shows, have only been mildly affected, but it is a concern. And as I pointed out, the Fed is shifting its concern towards the labor markets. If unemployment rate goes up or keeps going up, this is an indication to cut rates to boost the economy. So that is what the Fed is looking at right now. As I pointed out, when the unemployment rate wasn't moving and it was very low at around 4%, the Fed was not inclined to lower interest rates because it might add to inflation rather than hurt it. So that was an issue.
But do you think here that the recent changes in immigration policies, as noted by Powell, really impacted the labor force growth and the Fed's economic considerations?
Yeah, that's a really good point, Mona. The immigration issues could definitely have an effect on certain areas of employment and also create inflation, because most of the so-called illegal immigrants work in areas that it's very hard to find people to work in, notably agriculture. and also in a lot of service jobs in hotels and restaurants and whatnot. So if you take an aggressive stance against them, then you have a potential inflationary effect because you have to pay people more money to do those undesirable jobs. But of course that will not affect the unemployment rate terribly.
Now, you said that we're expecting two other reports by this next stage. According to Powell, how are the Fed's dual goal of price stability and maximum employment currently in tension here?
Yeah, well, that's precisely what this whole discussion is about. Uh, Unemployment, as I mentioned, is currently a bigger concern than inflation, although that could change. We were concerned that tariffs were going to have a very significant inflationary effect on prices, but so far that has not happened. Companies have absorbed the tariff increases. And also keep in mind that many of these tariffs are not as bad as originally planned because Trump has pretty much won most of the tariff wars. So this is not as much of a concern as it was a month or two ago. But as I pointed out, we are going to get an employment number and we're going to get an inflation number before the next meeting in September. So keep an eye on that.
But you're saying here that inflation is not a problem. But Powell here said that the Fed cannot allow a one-time increase in the inflation, in the price level to be an ongoing inflation problem. What did he mean by that?
Well, a 1 point increase would be very dramatic. Obviously, if we even came close to that, the Fed is not going to lower interest rates.
Then
But so
inflation
far,
is a problem, right?
inflation is always a problem if it occurs. The point is that it has not occurred the way we feared when President Trump was talking about all these very high tariffs. Some of these tariffs have moderated and come down as a result of negotiations with our trading partners. And so far, the effect of the tariffs have not resulted in high inflation, which is why we are expecting a rate cut in September.
But still, Mr. Tanis, there is a delay for the tariffs with some of the European countries, and also a delay in negotiations between the U.S. and China, right? So yet remain to be seen, right?
Correct. No, the Europe is pretty much under control. We've got those negotiations. I think the general tariff is around 15%, which is pretty acceptable.
Right.
China is still a question mark, and of course, it's a very big trading partner with the United States. But tariff negotiations are ongoing with China, and
so remains to be seen, Mr. Peter, right? Remains to be seen.
Say again? Sorry.
So it remains to be seen, right?
Exactly.
Right. From Washington, that was Mr. Peter Tanis, chairman of Linux Investment Advisory. Thank you so much for your insights here. And in the Minem region, Reuters have reported that Syria will issue new banknotes, removing 2 zeros from its currency in an attempt to restore public confidence in the severely devalued pound. The Syrian pound has lost more than 99% of its value since 2011, with the exchange rate now at around £10,000 to the US dollar compared to 50 before. According to Reuters, Syria's central bank informed private banks in mid-August that it intended to issue new currency by removing zeros. Gold prices rebounded on Friday, buoyed by heightened expectations of a September rate cut following comments from Federal Reserve Chair Jerome Powell at the central bank's Jackson Hole symposium. Spot gold was up 0.7% at $3,362.53 per ounce, dollars per ounce, while U.S. gold futures were 0.8% lower at $3,408.2. That brings us to the end of our economic bulletin. Here is what we've been covering. German economy shrinks by 0.3% in second quarter of 2025. Fed Powell announces policy framework tweaks for changed economic landscape. And Syria will issue new banknotes, removing 2 zeros from its currency. Well, this concludes our economic bulletin. Don't forget to follow Qnews on YouTube, Facebook, X, Instagram, and TikTok at Qnews. EGY to stay informed. Many thanks for watching and stay tuned for more updates on Qnews.